Chief Economist at FNB Mamello Matikinca-Ngwenya speaks to us now in reaction. A good afternoon to you, Mamello. The market did expect a hold on the repo rate, but how is it expected to react to the latest outcomes?
Good afternoon to you, Tmisang, and all the viewers. The point that you make around the outcome was aligned with consensus. So I think what's been quite interesting in the statement is that the central bank is quite set on ensuring that inflation returns within the midpoint of the target band. In the latest forecast, they've now moved that to 2025. They've highlighted quite at length that the risks to the inflation outlook remain quite elevated, and that they will be data dependent and give clear guidance of whether this deceleration that they expect in inflation is indeed materializing. So I think from a market point of view, what will be quite interesting to monitor is how the data transpires between now and the end of the year into early next year.
And that's going to be keenly watched. It brings me to my next question about the near-term outlook with regards to decisions in the future where monetary policy is concerned. Some analysts are already saying that their predictions for a rate cut have now moved from May to at least November or early 2025. What's FNB's position?
Absolutely. So we also hold the view that we are likely to see a turn in this cycle in the later part of this year, 2024 November. That's where FNB has the starting of the cutting cycle. But I think what's quite important is that as we see sort of how this data transpires between the end of 2024 to 2025, what will be quite key is that deceleration in inflation towards the end of the year. As I said, the risks remain quite elevated, and if it's not decelerated at the pace that the central bank expects, and inflation expectations are also not moderating, it may mean even if they do start cutting interest rates this year or early next year, that the cycle could potentially be a shallow cycle.
Let's talk about some of the stumbling blocks that could emerge throughout the year of 2024 with regards to economic activity that would not see a trajectory that is forecast by the South African Reserve Bank itself.
Absolutely. So I think the key things really to monitor would be any risks to the inflation outlook. So those could emanate from a currency that remains undervalued, or the depreciation of it worsens through the rest of this year, and that could be on the back of multiple triggers. It could be a domestic related event that results in a currency that weakens severely, or it could be triggered by international events that weakens the currency. We have seen historically that the impact of war or an intensification of war has implications for commodity prices. We are in a very dry weather season, and that may have implications for food inflation. Those are just some of the things that could potentially lead to inflation that doesn't moderate to the extent that the central bank anticipates. And I think the other one, in as much as the central bank governor speaks about they don't follow the Federal Reserve Bank in the US, they monitor the Federal Reserve Bank. That's quite key. If the Fed I think stand still and they don't move interest rates lower as the market anticipates this year, that is something that the central bank, our central bank, will certainly watch out for. He makes the point around real interest rates, that there are central banks globally that have started to cut interest rates, but that's because they have bought themselves a policy space to be able to do so, and the real rates in those economies are quite attractive. So I think the real rate will be an important one, which is a function again of what happens to the inflation outlook.
Finally, the Reserve Bank governor has stressed that the central bank remains prudent, and they will be watching global as well as local developments quite closely in the near term. What's to be said about the Reserve Bank being prudent versus what the real experience of a South African consumer is, which is under pressure?
I mean, that's an important point, Tmisang. And I think, where the central bank acknowledges that is that, they state, and they have stated in previous statements, that policy currently is very restrictive. So they acknowledge that. So I think, ultimately, high inflation is not good for anybody. And ultimately, you want to bring down inflation, and that's what they focused on. They focused on ensuring that inflation returns within the target band, and it is anchored over time at the midpoint of the target band. In the meantime, yes, the cost of living for normal South Africans is quite elevated. We see it. We see it just in terms of participation in economic activity from a consumer point of view. So I think just getting that balance ultimately correct is beneficial for everybody. It's like, again, I guess that short-term pain for long-term benefits to the broader economy.
Thank you as always for your contribution. Mamello Matikinca-Ngwenya is a chief economist at FNB, talking to us about the latest reaction to the Reserve Bank's Monetary Policy Committee once again deciding to hold on the interest rate at 8.25%.